Hey, welcome to the Guaranteed Retirement Guy Show. So today we're going to be talking about the infinite banking concept. So what is the infinite banking concept? How does it work? There's a lot of people that look this up on the internet that get super interested because of the concept. Really, the concept is kind of just being your own banker, okay? And if you set it up right, it can be very lucrative and it could help you really kind of make money in two different places at once. Or if you want to use the money elsewhere and just, other things that you want to get loans for without going to the bank, then it's a great way to do it too. So the way it's done is you're leveraging the rules and laws of life insurance. So when you create a life insurance policy, typically when we're buying life insurance, we're looking for life insurance on ourselves. So if something were to happen to us, we pass away, our family gets a chunk of change so that they're taken care of. Maybe the house is paid off, school's paid for, and of course the income that was lost from the breadwinner is basically reinstated. Okay, so they're able to take care of that loss. Now, another way to set up a life insurance policy is for maximum cash value, maybe tax-free income later on, but also being able to have the opportunity to grow wealth for yourself and be able to leverage it in different ways. Okay, you can allow money to grow within these overfunded policies. They're all tied to an index. So if the index goes up, then you get a ton of growth. And when the index goes down and the market's doing terrible, then the worst that can happen is you just don't make anything. And so it's important that you set these things up because, it's important that you set it up right because they're tied to a life insurance policy. So if you have your insurance too high, you got a huge benefit, death benefit, maybe $5 million or more, then it might eat up it might eat up a lot of your cash value, a lot of your growth, because you're having a huge amount of fees, and it really acts like a bloated mutual fund, which you don't want, right? So if you set this up, you got to set it up right. I set this up with a lot of my clients that need it, especially people who are maybe overfunding, or maybe you've already funded your 401k and you can't put any more into it. Or maybe you don't even qualify for an IRA because you make too much. There's a lot of different reasons people will set these things up, and they do it just so they can have more flexibility. Maybe you don't want to have the restrictions that an IRA has. An IRA doesn't allow you to take money out until you're 59 and a half, or they'll penalize you, right? So you can't retire early without having some penalties. Of course, if it's in a traditional IRA, it's also taxable. Okay, now if you put it in a Roth IRA, it's tax-free, but you still have the restriction that you can't take it out until you're 59 and a half or older. So, and then you have restrictions on how much you can put into it. And if you make too much money, you can't put anything into it. So there's a lot of cool stuff you can do with overfunded insurance policies. And myself, I love to use IULs. IUL just stands for Indexed Universal Life. And the reason why I like these, whole life is great too, but whole life is tied to, it's basically gives you a guaranteed death benefit till you're 100. And if you don't die at age 100, then they give you your payout, which equals a death benefit. Okay, for your Indexed Universal Life policies, you're looking at an index that is growing and it's not hindered. Your growth is not hindered by you're not limited like you would be in a whole life policy. Maybe a whole life policy, you're only getting dividends of, let's say, 2 or 3%, okay, at max. But with an index, if that index earns 10%, then you earn 10%. So that's kind of nice. So it gives you more growth potential and, of course, still protects you against market fluctuations, which, of course, is very important when people are thinking, all right, well, I want to protect my money, but I also want maximum growth. I want guaranteed income, and I'd like to be able to use this money in two different places at once. Maybe I could use it in this index and at the same time be earning money somewhere else. You can actually do that if you set this up right. And this is how the infinite banking concept works. So I'm going to show you on my computer exactly how I set these up. Okay, I'm going to show you one of the carriers that I work with. I work with a lot of different carriers, so it really does make a difference which carrier you set this up with, because some are better suited for the infinite banking concept more than others. Okay, so I'm going to share my screen. I'm going to go over here and I want to kind of show you what we're looking at. So this gentleman, we'll call him John Booth. He's from Oregon and he's 32 years old. Okay, I'm putting standard non-tobacco. And what I'm going to do after that is say, all right, once we've got it established how old you are and maybe average health. If it's better health, then obviously better rating means lower costs, higher growth. Okay, so I'm going to go in here and put minimum death benefit, maximum cash value. So I can choose a number of different things, but I want the goal of this policy to keep that death benefit as low as possible. Okay, we want as much cash value as we can so that this will work. Okay, and I'm also having the death benefit increase for 15 years. The reason for that is because I want to stuff a bunch of money into this. And in order to be able to stuff money into an index universal life policy, you have to have a death benefit that is high enough to make it possible. The IRS basically has these rules that if you're going to put all this money into your IUL policy, then you need to have a death benefit that makes sense. So what we do is we tell this software that we want to keep this death benefit as low as possible. We want maximum cash value, but at the same time, we want it to increase enough to allow us to put more money in. And you'll notice I actually have this end at year 15, and I push it down as legally far as I can. Okay, so I'm gonna scroll down here and you'll notice I already input some numbers. So I put $1,000 a month. Now we're being aggressive. You don't have to be this aggressive, but I just want to show you the nuts and bolts. Okay, so I put $1,000 a month for someone, for the first 3 years. And then after that, I graduated up a little bit more, $1,500 a month for a few more years, then $2,500 a month for a few more years. And then for the rest of the period, I have them doing $3,500 a month for years 11 through 36. So a pretty substantial amount. But I want you to see how this looks. And I'm going to solve this for income. So I want the income to start coming out at 37 years from now. Okay? So let's go in to the view here, and I'll show you exactly how it looks. So let's look at a few things. You'll see the planned premium. This is annual numbers. You see $1,000 a month, $1,500 a month, $2,500, $3,500. Okay, so you can see that graduating over time, and I have that going in until this gentleman is 67 years old. And I have, just for this illustration, I have him taking income at age 68. Okay, so he's taking at 68. His income is $291,000 a year for the rest of his life, and that's tax-free. Pretty cool, huh? And then he's going to take that out, and you notice he takes that out for the rest of his life. And then what happens is let's say he dies at age 96. Okay, he's taken out $291,000 for quite a while. He's taking millions and millions of dollars out in tax-free income. Now the insurance company will settle the account. And at this point, it's worth around $18 million, and they're going to subtract all of the money that he's lived off of, which he took in the form of loans. And that's how you make it tax-free, is you take it as a loan, not as income. And then what happens is they'll subtract that plus the interest, because interest was accruing, and they'll pay the beneficiaries the rest, which at this point is only $286,000. So not a lot, but again, this is set aside, or this is structured in a way where you can have maximum growth for maximum income. Okay, so remember that. All right, so let's go back to the infinite banking concept, because people put their money in this and they're like, well, I want to be able to use my money now. I don't want to wait. I don't want to have to wait till I'm retired to have tax-free income. I want to have, what if I see an investment like this rental property over here? Or what if I see some trust deed that I want to, put some money in, or maybe municipal bonds, or maybe some crowdfunding. I mean, there's so many different things that you can invest in, and you can do it without hurting the growth of your policy. So let me show you. So let's go back and we'll look at these two columns. You'll see accumulation value and you'll see surrender value. You notice the accumulation value, that is your money, that is growth, okay? And that is after the cost of setting this up. You'll notice it's pretty substantial in the beginning, but it starts to catch up with itself. After about 10 years, you notice that the accumulated and the surrender value equal each other. And from there on out, they equal each other. And it's just, That's just how these index universal life policies work. They are recouping their costs, and you can set them up where the surrender value will not take 5 years to get to equal the accumulated value. We can certainly set that up for you, but it might hurt your income later on. So it really just depends on your goals. But if you don't think you're going to need access to this money for infinite banking until later, then this would make sense, because now you have $300,000 of tax-free income that you're going to get for the rest of your life, but now you also have access to the money while it grows. So let me show you how that works. So you notice here at year 11, it's $163,000, and that's what you have access to in the surrender. So the surrender value is what tells you the amount of money that you have access to. Okay, so we've waited 10 years, let's say, to start taking money out. And what you're doing is while this accumulated value continues to earn interest, depending on whatever the index is making that year, the insurance company will actually give you a loan whenever you want. They'll do it based off of the surrender value of the policy. And so since the surrender value equals the accumulated value at this point, you just take the whole amount if you want. And what they'll do is they'll give you a loan, and they'll allow the accumulated value to continue to grow because you're not withdrawing it. It's kind of opposite of a 401k. You can take a loan on a 401k, but it's going to reduce dollar for dollar what's working for you in the market. Whereas with an IUL, you can take a full loan out, and it's from the insurance company, and they're just using your account value, your accumulated value, as collateral. Okay, and so they do that so that it is allowed to continue to grow. So that money is in an index, and it still continues to grow. And so if that index earns 10%, $163,000, $16,000 is going to be credited to that account, which is awesome. I mean, you're going to be at almost $180,000 after a year, and that $180,000 is working for you. Even at the same time, you might have a loan out for $163,000 working for you somewhere else. Now, here's the beauty of infinite banking. You can take that money, and we had a client a couple years ago. There was an annual review being done, and the client had about $310,000. So he had grown his for a while. Anyways, he took $300,000 out. Took it completely out. Okay, he took that out, and what he did was he put it in, I think, a promissory note where he was making around 15%. Okay, so he was making 15% on that $300,000. Now, this happened to be a very good year. I want to say it was 2021, 2022. He made around 14% in his IUL. Okay, he made 14%, which is pretty huge. So his account value was not $310,000; it was $348,000. So he had $348,000 now working for him, while at the same time he had a $300,000 loan out. And that $300,000 loan was making him 15%. Now, I'll be completely transparent. He was being charged interest by the insurance company, and I think he was paying around 3 or 4%. Even so, if you think about that, he is still netting, after the cost of taking the loan out, 11 to 12% on that $300,000, while at the same time his money is still earning the full amount from the index. So essentially, he's earning money in two different places at once with the same capital, and his real return rate is more like 25%. That's huge. So if you're thinking about how do the rich get richer, this is how they do it. And really, you don't have to, you can find a promissory note, you can invest in some trust deeds, you can do anything. If you want to use it to buy a car, I suppose you could do that, or pay for kids' college. I certainly recommend, if you take the money out, use it for investments, make more money, pay your loan back, and then do it over and over and over. Now, I would say the drawback is if you don't pay back your money, okay, if you don't pay back the loans, then at retirement, this amount of $291,000 is going to be reduced. Okay, so remember that. So I would highly recommend that you just kind of use this as a bank and continue to pay it back. Use it for investments, pay it back, and just keep doing it over and over and over. You can see by the time you're in your 50s, it's worth $1 million. Okay, and you might have some really big deals you're doing, but at the same time, you don't want to hurt your million that's still compounding for you. And of course, with the infinite banking concept, you won't, because you're getting a loan directly from the insurance company who's using your accumulated value as the collateral, allowing it to grow with the index, whatever the index makes, and still allowing you to access the cash in the form of a loan so that you can use it elsewhere and make more money with it. So that's the beauty of it. So if this is something you want me to kind of put together for you, I'm happy to do that. I mean, I can change these numbers. These numbers are kind of big. A lot of people will start at $500 a month. I recommend that would be at least the minimum starting point, and then graduate it up from there, because you really want to set it up in a way where you can stuff more money into it. And speaking of that, I wanted to talk a little bit about the MEC. The MEC is basically what it is. It stands for Modified Endowment Contract. And what that is the IRS, it's their limit on how much you can put into this policy in any 12-month period. And so you notice the MEC premium for this is $127,834. Basically what they're saying is you can put up to this amount in 12 months without this policy becoming a MEC. If you do, then it becomes a MEC, and once it's a MEC, it's always a MEC, which means, basically what it means is everything that comes out is taxable, which we don't want. We're doing this for tax-free income, right? So make sure you stay under that. That's why it's important to structure this in the right way, so that if you know in 5, 6, 7, 8 years that you're going to be stuffing more money into this and you don't want to be hindered, then you need to structure it right in the beginning so that you can put a lot more money into it later, even if it's much more. I mean, you can see in the first year, you're only putting $12,000 a year. But if you get an inheritance and you want to drop $100,000 in there without it becoming a MEC policy, you can do that. So it allows you to have that freedom to dump more cash in it, which then allows it to compound even more. So again, it's very important. You structure it right. You keep the death benefit as low as possible, which of course at this point is like $2 million, which is still kind of high, but it's as low as we can make it relative to how much money we're going to be stuffing into it over the next 37 years, right? So we have to be careful when we set this up, that we want to keep the death benefit as low as possible, but also keep it high enough so that we can put a lot more cash into it and really, really grow our wealth. Okay, that allows you to have tax-free income later on. It allows you to leverage your money in 2 different places at once as it grows. There's a lot of cool stuff you can do with it. So these can be very, very complex. I set these up for just people that are 10, 15 years from retirement, and some people are 30 years from retirement. Some people don't have very much money to put into it. They can only put like $500, which is fine. It's something to start out with. Other people I work with can put thousands of dollars into this. In fact, there's a guy in Michigan that's putting $2.5 million into his right now for 7 years. He's going to let it sit and grow, and he's going to take out around $1.4 million in tax-free income for the rest of his life. So there's some pretty big, I would say, extreme examples on what you can do. And then you've got most people where they can say, well, $500,000 a month is kind of more comfortable where I'm at, or maybe $1,500. It really just depends on you, your situation, but we can set it up for you. I would say the only thing is you got to be healthy. It's a life insurance policy. So it's good to have a good health history because you want the cost inside of it to be as low as possible. Okay. Another name for this is TFRA, which stands for Tax-Free Retirement Account. And you can learn a little bit about that. Even if you just look it up, you'll see what it stands for. But really, that's what it is. It's a TFRA. It's a tax-free retirement account where you're leveraging the rules and laws of life insurance to create a tax-free income for the rest of your life, and also being able to give yourself access to your same cash, your same capital, while it grows, while it compounds, and be able to use it at the same time somewhere else. Okay, that is the beauty of infinite banking. Okay, so when it's structured correctly, when it's put together right, it can really build a lot of wealth, and it can do a lot for you. So happy to go over that with you. Just book a call with me, and we'll go over the numbers, just individual numbers for you, and I'll show you how it works, and we'll look at exactly what you can expect in the future. So yeah, book a call. I'm not going to try to sell you anything. It'll be a very easygoing conversation, and we'll go through the numbers, and then it's up to you. You can decide what you want to do, but at least you'll have that information at your fingertips. All right, thanks for watching, and we'll see you next time.